let me explain why we are resetting the option strategy. Many of you, those who are in the market for a 1+ year or 1+2 year, you will be knowingly or unknowingly you will be forming the option strategy. Like suppose if you are just buying a call option and buying a call option and buying a put option. So in this case also this is considered as a strategy. When multiple call or put options is being bought or sold with risk neutral approach, that process of trading is known as your option strategy. Simply if you buy a call option, put option of XY strike, say X strike is for Nifty is 6,100 and you are buying a put option also 6,100, this also comes to be a strategy. So the Chicago Board of Commodity Exchange, which is the Chicago Board of the Option Exchange, which is the authority who has named specific strategies. They are not the authority of our Indian market. However, they have named specific strategies like saddle, strangle, god, condor, iron condor, butterfly. All these strategies they have named it. So that has specific sequence. Suppose if you are buying same strike call option and put option, that it has a name. If you are buying a different strike call option and put option, that has a name. If you are selling a call option or put option of same strike, that has a name. So all these things are known as the option strategy. Why this option strategy is being formed? What is the objective of forming this option strategy? Why not simply buy one future and hold it for infinity days? Why not sell a future and anticipate that it will fall down and you will make money? Why not keep a stop loss and exit from one particular point? Basically, option strategy is being formed with one pre-objective aim. With one pre-objective aim from the trader. Trader specify how many days he need to hold this strategy. Trader specifies what is the maximum loss he can able to bear. Trader specifies what is the maximum gain he can get. Maximum gain he can get from this strategy. So here trader has the complete control over his own money. He specifies, yes, I wish to hold it for 3 days. Yes, this is the maximum loss I can able to take. This is the maximum profit I can aim from this trade. So all these pre-objective settings is being done by the trader. Assume if you are buying a future, you do not know whether it will rise 50% during 1 month or whether it will become to a dust, means fall down by 50% or 60% from its current position. So that aspect is not known. Though technical parameters you can fix it off, you can put a stop loss, come out, all those things never says anything on the risk management. Capital risk management is not being done for an intraday trader or for a trader who plainly believes on the technicals and enter to a trade. So capital risk management, one new term I am introducing here, capital risk management. This CRM or the capital risk management is not being done in a plain trade. In an option strategic trade, capital risk management is being done. So whenever we are doing this capital risk management, we need to understand specific facts about the options. So option has a volatility, every option has a volatility. Because today's session I will be taking in the advanced aspects, I will not tell what is option, what is call option, what is put option, those are the things I am not going to take. I will talk in terms of some advanced concepts. So what is implied volatility? Implied volatility is a volatility associated with a particular strike option. Like your stock future has some volatility. On volatility you will get enough lectures from our site, enough literatures I have flagged in my site. However, implied volatility is a volatility which is associated with the option at a particular time. At a particular time, one X strike option, at what volatility it is trading, that is known as your implied volatility. And I just want to bring to your notice one thing. There is no straightforward formula to calculate implied volatility. Like other things, we have specific formulas. For implied volatility, we do not have a straightforward formula which says that apply this formula, find out the implied volatility. So this makes the nature of implied volatility more difficult. So to do the capital risk management, you need to understand the behavior of the implied volatility. Then you need to understand the behavior of the open interest. Whenever any contract is being formed, like if you are saying that open interest of a future contract is 1, means one lot of a particular future is being bought and same time somebody has sold it also. So this buy and sell, both the action contributes to the open interest of 1. This buy and sell doesn't contribute to open interest of 2. This action of buy and sell which forms one contract, this one contract is known as your open interest. That open interest, some of the interesting behavior also we have to understand and we have to study. Then we have to form the option strategy with specific objective, with capital risk management in our prime goal. We have to form the strategy. So capital risk management, whenever we are doing, sometime we will be neutralizing the fact of implied volatility. Sometime we will be neutralizing the fact of the price movement of the underlying asset or the contract. Sometime we will be neutralizing the volatility of the underlying asset. Sometime we will be, because every contract has a time value also, so once you are approaching towards the expiry, the time value will decay and come down to 0. So sometime we will be neutralizing in terms of time value. So all these things of management is known as your capital risk management. But simultaneously, you cannot manage all. You cannot manage volatility. You cannot manage delta, volatility, vega, theta, everything at a stretch, because that is not possible. So what happens here? Only one slide I am showing. So do not get worried that slide is not moving. Only I am in the first slide. I'm just scribbling something on that. So fine. So here what happens? The capital risk management, whenever you are doing, either you have to do it 1 or 2. If you make it 2, then it becomes little complex. But if you multiple parameters you are going to neutralize, then it will become too complex, and at end it won't yield anything. It won't yield anything, or it will not result any profit to you. So here one thing is very clear. We'll be doing capital risk management which protects a part of our capital. However, excessive capital risk management, I do repeat, excessive capital risk management increases the complexity and reduces the performance, or reduces the return also. And sometimes it won't give you any return also, excessive management. So now we need to follow a balanced approach that says that capital risk management also will do to protect our capital. Same time, we have to follow one balanced approach where it should not be more complex, because excessive complexness in that won't yield anything. So that part also we have to keep in mind. So first I am focusing on the implied volatility part. So the implied volatility, which is a volatility associated with a particular strike option, has the following criteria. I have just listed out 6 to 7, but it has many. Implied volatility decays every day contracts nearest to the expiry. As you are nearing towards the expiry, the IV or the implied volatility used to decay, and it has to decay down to a stage of 0. So this is first property. Implied volatility increases if the contract volatility increases and vice versa. So the contract means if you are having a Nifty option, I am just denoting as such NO, Nifty option, and Nifty future I am just denoting as NF. So if the Nifty future contract volatility increases, so options volatility also will increase. That means the IV will increase. If Nifty future volatility fallen down, these two also will fall down. This is second property. So IV, whenever the implied volatility is in the medium volatility band, so medium band for me, if a group of option strikes is in the between 30 to 40 of their implied volatility, then I will say that the contract is in the trending zone. It is a trending. Most of you, those who are literate in the technical analysis, they will be knowing that what is a trending band, what is a trading band. So when we should say it is a trending, whenever majority of the implied volatility, because every option will have the measurements different IV. Whenever a group of implied volatility or majority of the option strikes maintains a band of 30 to 40% of IV, that time we say that price is in the trending nature. So trending nature, that time we used to say that price is in the trending nature. Got the trending nature of the price action, will come to know if the IV of the majority of the option strikes maintain in the medium volatility band. If IV maintains in the low volatility band, means less than 30%, if majority of the implied volatility is less than 30%, then it is in a trading band, traders market, trading band. So this is the fourth property. Fifth, increase in IV brings profit in the open-ended option strategy. So what is open-ended option strategy? So increase in IV brings profit in the open-ended option strategy and vice versa. What is an open-ended option strategy? Say you are buying a call option of 6,100, assume at a premium of 140, and you are selling a 6,300 call option, assume at a premium of 100. This is assume, you are doing some assumption. So here you bought by paying 140, you sold it by paying 100. So the net amount whatever you have paid is 40. So if you are going to lose, you are going to lose this 40 rupees. If you are going to gain, your gain will be 200. Thus between the strike, what is the difference? Minus 40 whatever you have paid. So maximum gain is capped at 160. So whatever the respective lot size, you can multiply and you can derive the net profit and net loss. So this kind of strategy, when your profit is capped and it is not going to increase beyond 160, is known as the close-ended strategy. However, if I will just change this same strategy, make it in this term, buying 6,100 call option and buying 6,300 call option also. So here what happens, your loss is limited to the tune of premiums you have paid in both, which is coming to 240. However, if the Nifty moves to 7,000 or 7,500 or anything beyond that, or if Nifty fallen down to 5,000 or below that, so your profitability also going on increasing with respect to the movement of the Nifty future. So that is called your open-ended strategy. When profit is unlimited or profit has no scale, no boundary, no arrest, so that time we can say those kind of strategies are called open-ended strategy. What is a closed-ended strategy? The strategies where maximum loss is also capped to a certain extent, maximum profit also being restricted, arrested to a certain level. So here in this case, if you are buying this one and selling 6,300, buying 6,100 strike, irrespective of the Nifty move to 7,000 or to 5,000, I am calling about the call option I have taken. So in this case, your loss is restricted to 40, your profit also restricted to 160. You are not going to gain any 1 rupee more than 160. So this is called as a close-ended strategy. So IV increases means profit in the open-ended strategy will increase, and decrease in the IV brings profit in the close-ended option strategy, close-end option strategies. So this is what it says. So lots of information I have given on implied volatility in these 7 points. Furthermore, based on your expertise and experience in the market, you can understand the behavior of implied volatility in a more accurate order. So how we can form the option strategy using this one? So you should form close-ended option strategy with net IV near to 0 in high volatility contract or contract which is having a high volatility. Means the futures which is having a high volatility above 40% in annual terms, in such kind of contracts you must form close-ended option strategy, because beyond this volatility is not going to go up, rather it is going to stagnate in the high level or it is going to fall down from here. Henceforth, close-ended option strategy is a good money management, capital risk management strategy in this kind of situation. So, and IV must be near 0. And second point, form open-ended option strategy when the net IV is in the medium, means with a net IV positive in a medium volatile contract. If the volatility of the contract is above 20% and it maintains below 40%, in such kind of contracts you form the open-ended option strategy with net IV positive. Little bit of positiveness you can give. And you can form close-ended option strategy with net IV negative in low volatile contract. So I have just given you in different volatility condition in the contract. In if your Nifty is high volatility, means having a volatility above 40, what kind of strategy you should form? If your Nifty is having a medium volatility, what kind of strategy you should form? If your Nifty is having a low volatility, what kind of strategy you are going to form? And whenever you are forming such kind of strategy, what will be your net IV? Because multiple actions you will be initiating. You will be buying one call option, selling a call option, buying a future, selling a call option, buying a put option. All these combinations you will be forming. So that combination should have a higher volatile contracts, have a net IV near 0, medium volatility contract, net IV must be positive, and for the lower volatility contract, net IV must be negative. So this is how you should arrange your strategy. And certain cases what you will get, like Infosys result is there and it is going to come after few days, and all your options, though underlying asset is, means stock is not moving, stock is very choppy, it is just waiting for that result to come, but all your implied volatility of options is 50, 60, 70 like that, percentage it is lying. So if any case you are finding out IV is higher by 50% from the contract volatility. Contract volatility is X means, and IV is X plus 50% of X, 50% of X added with the X. If IV is above this one, then you must form the near zero IV strategies. Form in such a way that implied volatility should be zero. So this is how the strategies can be formed in a or considering the implied volatility. So I will be demonstrating one thing. So now market has been closed and market is no more. So we'll be going for the NSE site, nsindia.com. So first thing what we have to understand, we have to investigate the volatility of the, so let me open up one Excel sheet here. We need to understand the volatility of the underlying asset. So I am just taking one index into my account. Preferably I am taking for the Nifty. So I have just chosen the Nifty. For reference point, for our reference, I will be just clicking on this. It is telling me annualized volatility is 27.36. So Nifty annualized volatility is 27.36. Can anyone will tell me which kind of volatility situation it is now? High, low, medium. Out of these three answers, can anyone will give me one answer whether I am in high volatile band, low, medium? For Nifty, not for the Nifty options. Many of my webinars, those who have joined earlier, I have told you less than 20%, so less than 30% you will be, it is not with respect to the option, it is with respect to the future I am talking about. I am talking about with respect to the future. The future Nifty is having 27.36. So how I can classify, whether I should classify it as a low or I should classify it as a medium, or I can classify it as a high. Majority of view comes as medium. So medium is the volatility condition, less than 20%, low, above 20, below 40. So this is the range we are keeping for the medium. This is low, and above 40 we are just going for the high volatility band. So our volatility of the Nifty is in the Nifty future especially is in a medium volatility band. Now investigate on the options. So investigate on the options. So here the IV comes here. Implied volatility of options is flagged by the NSE here. So if you just see, because many of these mispriced options also will be there, 91 here, 63 here, 43 here. I can just, if I can scrutinize it, it will be better. So I'm just demonstrating this thing with our newly built up option strategy software. I'm just loading the data so I can get a concrete picture, or all these things which is being spread out in a different way. I can just summarize it and get it in one platform. For that reason only I am using it. So here you are getting those who are deep in the money options or deep out of money options, they are maintaining in the band of 30. However, like if I can just take a estimation from 5,500 to 5,500 to 6,500, which is the idealistic level for my movement, in there I am finding out 18. It varies from a range of 17 to 31. So this is the range is varying. But most of these strikes are coming in the 20, 21, 22, 28. That is the range it is trading. So, and if I'm looking into the means IV part of my put options, deep out of money is like 4,900 and all. I am just skipping it because those premiums are meaningless, 1 rupee 60 paisa, 2 rupees. So if I'm just taking a consideration from 5,500 to 6,500, same levels, if I'm just concentrating upon, there too also I am getting in that 20 to 25 range it will be there. So average, assume average we are saying that okay, we are in the 25% of the IV. Average IV of the tradable options is coming to 25 average. So deep in the money I am just ignoring. Deep out of money I am ignoring. Nearest options if I am taking, it won't come 25, it will be near to 25. So I said that okay, average it out and accept it as that yes, we have a average IV of 25. So average implied volatility is coming in a band of 25. Volatility of the Nifty comes to 27.36. So come to this particular slide. Which kind of IV situation we are now? We are in the medium volatility condition here. We are in the medium volatility condition here. And here we are in the low volatility condition, because till 30 I can accept it as a low. So majority of the options are not in the 30 range. So only couple of, if I'm taking from the 5,500 to 6,500. So in that range, if I am just taking the things, only 2 entities are having 31 above. Remaining things are below 30. So I am saying that I am at a low volatility condition in the options. In the options, I am at a low volatility band. So implied volatility suggests that I am in a low volatility band. So what kind of market you are? Are you in a trending market? Are you in a trading range? What kind of market situation is now? What kind of market? I have shown you the slide. Close-ended strategies. Close-ended strategies need to be formed. So close-ended strategies need to be formed with net IV as negative. Net implied volatility as a negative. With close-ended strategies we can form, so that we can take the benefit of the time value decay. So I am just going to the strategy builder now. So I have just, so say I'll be forming any of this strategy. Say I'm buying it one lot, then I'll be selling some call options. Say call option 6,000, I am going for 6,200. Based on the IV only I am going to form. I am selling it. Say I am selling one lot at 81. Holding period 3 days. I'm not going to do anything here. I'm just going for my Greek scanner. Here only I'll get all the IVs, which is the tradable IVs, implied volatilities. So IVs, whatever is there, I need one net negative IV. I am currently at a level of 6147. So 6,150 level I am now. So 6,150 call option, which is quoting at a level of 21. 6,150 call option, which is quoting at a level of 106. I'm having a implied volatility of 21.21 or 21%. So 6150, which is having 0.21. If I can do in this order, suppose I am doing it in this order, say I'm just buying, say I'm just selling 6150 call option at 106, and same time I am going to buy, so it is having a 0.21, 6150 call option 106. So same time I'm just going to buy one option, say 6350 at 31, 6350 call option I am going to buy at 31 rupees. So which is having a implied volatility of 21, and with respect to this one 6350, which is having 19, so 19. So I have sold this, I am bought it. So by selling this process, IV become negative. By buying this one, my IV become positive. So my implied volatility comes to -2. So what happens here? What happens here? This +2 or -2, how significant it is and what it suggests me. So currently my Nifty, which is near to 6100, and this is Nifty spot. So my Nifty, which is 6147, so 6147, I have just bought a call option of 6350, and that's to one lot, and I have sold a call option of 6150, and I have sold it one lot at 106. Some net credit I have got. Say I am going to hold it for 3 days. I am going to calculate these levels as per this thing. I am just going to calculate these levels. Once Nifty is going up, then I'll be incurring specific losses. And if the Nifty is decreasing, then I'll be making some profits. That is true as per this nature of the strategy. But my net IV has come down to -2. What does it means? Can anyone will tell me? So here all 106 is a time value. This is 31 also totally time value. So I have received a time value of 106, paid a time value of 31. So my net time value which I have pocketed from this trade is 5, and 10 3s are 7. 75 rupees of time value per unit I have pocketed. So this net of -2, how significant it is? This says during the period of till expiry, till the day of expiry, if Nifty future moves in the between the 6350 to 6150, this is the range, the strike which I have taken. During this range, if it is going to move, each 1 day passes towards the expiry, I'll be getting 2% of this one. 2% of this time value will be converted to the monetary profit, provided during till the expiry, if it moves in the range of 6150 to 6350, provided we have to, again, intrinsic terms we have to calculate. Till 6250 we are protected because we have just sold this one. So we'll keep some other analysis, but the theoretical meaning of this is, implied volatility of -2 says that 2% of time value will be converted to the profit. Means every one day you pass towards the expiry, 2% of 75 rupees will be your profit, provided till the day of expiry if Nifty moves in the between of 6,150 to 6,350. So now it is very important and crucial for me, if I am going to hold it for 3 days, 5 days, 7 days, whatever maybe, where Nifty is going to move. So initial estimation as per the volatility for 3 days period, initial estimation says that Nifty will move in the band of 6,194 to 6,099. Means 6,100 to 6,194. This is the band for the Nifty future for coming 3 days period as per the volatility. So these two also I will not tell you how it is being calculated. Second, once it is breaking this 6,194, then you can move to the 6,223 to 6,194. This is the band will be set if in the upper side it is giving a breakout. If it is giving a breakout in the downside, it is going to give you a band of 6,070 to 6,100. So this is the successive levels as per volatility. However, we have also devised a fantastic tool for trend analysis. This says that during this month or this cycle, how Nifty is going to move. The first cycle of the Nifty is going to be completed at 6,245. First downtrend cycle is going to be completed at 6,049. So this is the level at which Nifty is going to move in a monthly measure cycle. In fact, we have also more precisely given the weekly trends. Suppose today's price is being taken into account. So in the first cycle, the Nifty will move in the range of 6,203 to 6,090. So at this point, what is my profit? If I click here, it will tell me 1,200 profit loss. I can 1,288 loss. I can get it if Nifty goes to 6,203. I can get a profit of 464 if Nifty fall down to 6,090 level in the first cycle. If my first cycle completes, then I can go for the second cycle and third cycle. So this is the maximum within a week. These 3 cycles can continue. And we have a perfect consolidation band also. This also we have given. So during this 1 week period also, we have the probability to consolidate in the band of 6184 to 6128. So today you are taking the reading. From today, 1 week period, you have the consolidation band 6184 to 6128. You have the maximum, one cycle is 6,203 and beyond that it can go to 6,261, 6,318. This is the maximum anticipation during this, means if all 3 cycles are being completed. But normally in the lower and medium volatility, maximum the 2 cycles used to be get completed. It never goes to beyond that 2 cycles. So consolidation band also is being given, and during this consolidation band, if I am consolidating, assume in the 6184 to 6128, assume I am just going to be I am consolidating in this band of 6184 to 6128. So which is this price? I'll be having a 986 rupees losses if I consolidate in the upper band. I'll be having a 98 rupees losses if I'm consolidating in the cycle 1. So this is also it tells you. So band of Nifty for the week starting from today is being set to a maximum range of 6,318 and to the minimum of 5,979. So which is the maximum and minimum. If you take a reading on this, so 3,000 I may lose if I am forming this strategy, and if this strategy gives me 1900, I can gain out of this. So in this situation, what will be my profit and losses, that also precisely you can able to calculate. But theoretically, if I'll say 2% of negative IV means 2% of time value we are going to take, and provided the first theoretically if we are taking 6150 strike, we have sold it 106, so till 6256 we are protected. Beyond that, this selling side will come to a liability, or it will incur losses for us beyond this if it is moving. And same time also 6350 call option would have been increased to a great extent if it comes to 6256. So that time we can think of closing it and come out with a small losses. But the very idea is we are in a low volatility, low to medium volatility band as per the options and as for the future. Henceforth, we are going to form the strategy which is going to gain from the time value decay. So close-ended strategies with the net IV as negative, we have formed with that approach. What happens if I initiated the strategy and the next day the IV has increased, or next day the volatility has increased? Then my perception will go wrong. Then I have to change my strategy, or then I have to come out from this strategy and form a strategy which satisfies to that implied volatility condition. So this is what on the strategy using the implied volatility. But one demerit is there. Whenever forming the strategy with respect to the implied volatility alone, it sometimes gives you the false assumptions on the price move. False assumptions on the price move. Henceforth, it has a deterrent effect on the on your portfolio, only neutralizing the implied volatility to near zero, to negative, to slight positive. Doesn't gives you profit, especially in the low to medium band. Whenever you are in the high volatility band, that time it gives you profit. Like in Infosys, day for the result announcement, 3100 call option. I recall, and I will just tell you, 3100 call option was quoting at 206. 3300 call option was quoting around 89 rupees. 89 rupees. So this was the situation of the Infosys before result. So that time IV was too high, higher by 50% on this. If you are forming one, say by here, and you are forming a sell here with a small positiveness in this, this makes a sense. On the day of expiry, if you just see, this is stagnated at 180 or 190 level. However, the fall in the IV has brought it to that level. However, this has fallen down to around some 40 rupees. So you can say 10 to, so those are the situations before result, before anticipation of a major event in that particular counter. If you are taking IV neutral strategies or implied volatility near to zero strategies, that rewards to you certain extent. That rewards you certain extent. But it is having the deterrent effect when the normal market condition will be there, when the prices will be in a great means a trending or trading band. That time it never rewards you. So that is the demerits of IV neutral. Now moving to the next part, and very next part, delta neutral also will see. What is the behavior of open interest? Open interest means number of open contract at a particular time. Highest open interest in the open interest strike call option is considered as a resistance. So if I'll just go back to the same example of your Nifty. So this column is representing your open interest. So if I'll just go back to here, so you have a 6,300 in call option, which is having 6,300 call option having near about 45 lakhs of open interest. 6,100 call option is also having near about 43 lakhs of open interest. So that says my initial resistance will be 6,100. Beyond that, if I crosses that, I have a close resistance at 6,200 also. Then I have a close resistance at 6,300 also. Once I cross that, then till 6,500, I do not have much resistances. So the traders at this particular time feels that 6,100, 200 and 300, which is having a maximum accumulation of the call options, are the resistance points for the Nifty. Similarly, if you just look into the put side, the supports for this particular Nifty series, maximum at 6,000 initially, then it follows with 5,900, 800, and sometime if you can say that maximum support lies at 5,700. This is the maximum level of support because of its open interest. Highest amount of open interest is there. But if you classify in this term, 5,800, 900 and 6,000, these three levels of your open interest suggest that all these supports are equal in power, so they have almost equal open interest. So even though if 6,000 breaks and it comes down to 5,800, I will not be surprised. The person who has hedged it 6,000 here, he also hedged at 6,000, 5,800, or equal amount of people involved in this hedging of Nifty futures at these three levels. But if someone says me whether 6,100 is a support, no, because it has a lower interest, lower open interest. So open interest of a highest open interest of a call option is known as your resistance. Highest open interest strike of the put option is known as your support at a particular series. But currently these two terms are irrelevant for the option trader, because many traders have entered to the market with plain options. They bought some option, they sold some options, some plain options also many traders has opened up. So all traders are not utilizing the option as a hedging instrument. Many are utilizing it as a trading instrument. So for this, these 2 points sometimes gives you the false implication on the market. You may assume that this act as a resistance or support, but it may not obey, because many contracts are being opened not with the anticipation of hedging, rather anticipation of a trading gain. So that's why this is not a good point to follow these 2 parts. And then next part, what we can follow it, a rise in open interest with the rise in volume, traded volume, excuse me. Rise in open interest with rise in the traded volume with the rise in the price indicates the strong bullish move above, means bullish movement in the counter. Same way, rise in the open interest with the fall in volume and fall in the price, this indicates the bearish trend in the price. So these 2 implications only you can take. From that you can derive specific strategy which suits to your capital risk management model. However, if you can do a trend analysis, that produces a very good result. Now coming to the most important part of our today's session, which is delta neutral trading rules. So delta of an option represents how the option price will move with respect to the change in the underlying asset price. And delta varies from 0 to 1 for call option, 0 to -1 for put option. Future of the delta is always 1. Suppose if I say one call option is having 0.26 as the delta, that means each 1% rise in the underlying asset will bring 26% rise in the call option. This is what the meaning of the delta is. So whenever you are forming a delta neutral strategy, that time your approach will be a 3 different view approach. The first view is, if you are saying that if any of your approach is saying that you are trend positive, then trend positive means you should form the delta neutral approach with positive delta. Trend negative means you should form the delta neutral strategy with negative delta which suits to your risk level. And whenever trend neutral approach, you form a strategy with delta equal to 0, near to 0. So minimum you can, because little bit of, I told you, excessive money management reduces your performance. So little bit of risk you can take. Not 26%, but it is not ruled out. You should take some 3% or 1%. If you are just bringing this delta to, instead of 26%, 2%, then through some sell or some other action, then rather I'll be happy. Yes, instead of 26%, you managed 24% and you brought it down to 2%, but little bit you have to keep based on their trend nature. So here, bringing down that delta from its original level to a level which suits to your objective is known as your delta neutral. Say, how I can bring it to a delta neutral? I do not know how to make it a delta neutral and all these things, but how I can make it? Say, assume I have just done this one. I just bought one lot here. I sold a call option. So I am just selling some call option also. 6,200 call option. I sold one lot at 81. So 6,200 call option, 181 I have just sold. I am going to hold it for 5 days. I just analyze this thing. Okay, some profit loss has come, all these things. Now let me go to the net Greek. What is my net Greek here? My net delta is 0.54. Net Greek at this particular time, it is 0.54. And from 0.54, it is going in a reducing trend and it is going to 0.06. And that time I am just gaining some profit. And from this 0.54, I am just going on increasing and it is coming into a increasing trend. I am just incurring some losses. I am incurring some losses here and I am incurring some profit. My profit is being capped. My losses is not being capped. It is an open-ended strategy. Future is being bought. Call option is being sold. Net delta is 0.54, which I do not want. I do not want that 54% of the risk. 0.54 means 54% of risk associated with 1% rise or fall. That 54% is terms of time value. So 54% of time value risk I do not want. So I want to bring this 54 to a near 0. So what I have to do? The easiest way, I'll just go for a Greek scanner on the put option and I'll just find out which of my strike is having a delta near to 0.54. So I got a strike here, 6,200 supports, 6,200 strike, which is having a 0.5194, quoting at 135. So I'm just adding one more here. I'm just going to add it. I bought a put option, 6,200, 6,200. Assume I did like this. Put option, I bought it, one lot, 135. So now same way of calculation. My liability has reduced to a great extent here. My profitability also become all this thing, means in the negative zone in many of the cases. However, my net Greek, what has happened, which was 0.54, the net Greek which was having a level of 0.54 now reduced to 0.0023. So if I multiply it with 100, so I have brought the net delta to negative 0.23, which was between above 54. So 54. So what happens, though I have reduced it, But what happens here? My profitability is not there till I am going to 6,500. Whatever level I will move in 6,200, 245, 267, I do not have any profit in this trade. Same time, my loss is being restricted here. Though it was 10, 15,000 losses, it is being restricted to a great extent. But I do not have a profitability at all in this also. So why it has happened like that? I managed the Greek well. I brought the delta which was 0.54 with excessive management. I have brought it to 0.0026, which is 0.26 level I have brought, which is near zero if I multiply it by 100. From 54% of time value risk, I have brought it down to 26%. What happens here? This case is called as a critical case of a excessive management, excessive capital risk management. So here, whenever you are deriving this level, what parameter I have given? Greeks, you manage, but bring it to a level of +3. So minimum you have to, or the maximum management you have to do in such a way that your Greeks which was 0.56, delta which was 0.56 must come down to 0.03. So it will be 3% minimum you have to keep. Then only this strategy will be viable for profit. It is not wrong that you have managed the Greeks in a great way and delta you have brought it down to a great extent. Theoretically it is correct. It is good to write an exam and get some marks on that. But it is not good for a practical trader who aims something from the profit. Assume if I just do in this order. So I am just going to change these things in a great way. So 6,200 which was 0.51. So let me go to one level, say 6,150 which is 44. 6,150 which is 44. But this particular case we should not do the delta neutral approach as for the Nifty. So if I am just deriving in this order, instead of 6,200, if I just go for 6,150. So same way of calculations. So what happens here? My net Greek which has come down to 0.08, 0.56 to 0.08, which is coming down, means in the percentage term 8.73%. So it is a applicable level. So this level is a accepted level, though the parameter of losses and profitability is still shaky, but it is an acceptable level. So bringing down Greeks to 0 also is always not viable. So always not viable. So here I have given you the points like this way. Delta neutral is formed with a trend positive, trend negative and a trend neutral approach. You must keep a minimum of 3% and maximum 30% range of the Greek, of the delta, net delta, minimum 3, maximum 30, for a viable strategy, the strategy which can award you the money. So these are the parameters highly essential for a trade. So I'll just same strategy, let me transform to a different level. Let me see what is the, see, weekly trend is telling me this one. Weekly trend is telling me Nifty cycle 3 is going to terminate at 6,300, and if the downtrend comes, it comes to 5,979. So this is what my weekly trend, 5,979 to 6,300. This is the level I am quoting. So if I do in this order, let me see what is same strategy I am forming, but with a different aspect, with a different aim. I just saw the things, so I am just going for 6,300 call option I am selling, and 59798 it is coming. So take me 5950, put option buy, 1 lot 5 days, calculate. So entities has turned to a profitable venture. So 5970 level my downtrend is expected, and net Greek is still 54. So I do not want this one 54. So I'll be just doing in this order. So let us add 2 lots here. So recalculate, do a reanalysis, 0.33. So acceptable, 30%, 0 to 30% will be accepting. So here what happens, if I come down to 5900 level, my liability is 4000, and if I am anticipated 6300 level, then my profitability goes to some 820 rupees as per the predictions in this case. So by this process also we can manage our trades with the delta neutral aspect. So this is a software we have recently developed, and I'll just tell you the major feature of this software, so which is highly used for the option strategy alone, and this has all our inbuilt strategies, like 22 strategies which is being given by me in the futures and option book that is being programmed. You have given a user interface which I have shown you here. So by using this user interface, you can form any 5 leg strategies. Means 5 different call option, put option you can put and balance it and bring it, form any kind of hybrid strategies. Maximum holding period of 10 days is allowed. It has an advanced trend finder. It has a net Greek analyzer and Greek scanner which can help you to neutralize any kind of strategy with respect to delta, vega, theta and all. And this is the strategy which can means this is a tool which can help you in many ways for forming the strategies. So any questions related